So welcome to our last class before we do our group project presentations on Wednesday. So what I'd like to do today is talk a little bit about the way that the rest of the semester is going to play out, talk about the project presentation requirements for Wednesday, and we'll go through the Walmart homework as an example to help you prepare for Wednesday and for your written papers. So if we think about the way that the rest of the semester is going to play out, I'm going to go back to our syllabus and just remind everybody that on Wednesday, at the beginning of class, you need to turn in a printed copy of your PowerPoint presentation. Right? So all teams, regardless of whether you're presenting on Wednesday or Monday, need to turn in a printed copy of the PowerPoint. That is the PowerPoint that your team is going to present. So two very important things. One, I want the printed copy so that I can grade as I go along, because I'm going to give you a grade at the end of the day after you made your presentation. Two, in fairness to the other groups, you can't present something that's not in that PowerPoint. So let's say you observed that you forgot to talk about something, so you open up Excel and you show your model to show what you forgot about. That would not be fair to the teams that have already presented. So the only thing that you can present that's going to be considered for a grade is what's contained within the PowerPoint presentation. So if you leave the PowerPoint and go to something else, I'm just going to stop listening to whatever you have to say. Right? So therefore, you can only present what's in that PowerPoint. So again, every team will print out a copy of the PowerPoint, turn it in at the beginning of class on Wednesday. 3 of you will present on Wednesday. The ones that don't present on Wednesday will present on Monday. Right? Yes?
Just 2 things. Is it like we choose if we want to go, like we raise our hand or something?
Well, I'll start out with, there's a couple teams that have some specific requirements based on team availability. So if somebody has to go on Wednesday, they get first preference. But other than that, I'll take some volunteers.
Okay, and then the second thing is, it's obviously business attire, correct?
No.
Or we could just wear whatever?
You can wear whatever you want. I will grade what you say. I will not grade how you look.
Okay.
All right. So you're welcome to come dressed as you are today. All right. But if you want to get dressed up, you can get dressed up. But again, for purposes of the presentation, just, casual attire is fine. Okay. All right. So 3 of you will present on Wednesday. The other teams will present on Monday. So one other thing about the presentation. Your group project is worth 20 points of your semester grade. Right? So 4 of the 20 points will be the PowerPoint. 16 of the 20 will be the paper. Right? The way the PowerPoints can be split up, 1 point per section. So 1 point on EIC, 1 point on the historical 5-year, 1 point on the comps, 1 point on the valuation. Right? So I will give you feedback at the end of the day. So I'll say you got a 3.5 out of 4. Here's where I thought you were weak. Here's where I think you can improve. So my suggestion is take whatever feedback I give you in the PowerPoint, adjust it for your paper, because your paper is worth 16 points or 4 points per section. So even though you're covering more information in the paper, it's really the same topics. And so think of your PowerPoint as kind of like the dry run. It's like a graded dry run. But if you do well on the PowerPoint, you'll probably do well on the paper. If you don't do well on the PowerPoint, then at least you should know what you need to improve by the time you turn in the paper. Yes?
How immediately will we get feedback?
So the 3 teams will present. I'll basically say thank you, and then for the 3 teams that presented, stay, and I'll give you your grades and feedback. So right at the end of class.
Okay, and then the final group paper is due next Wednesday?
It's due Wednesday, May 8th.
So everyone will have presented by then?
That's right. So that's what I said. You either present on this Wednesday or the 1st or Monday, and then you'll have some time between that and Wednesday to get your feedback and incorporate that in your paper. Okay? All right. So in addition, on Wednesday, stock track trading ends. So Wednesday, May 1st is the last day of stock track trading. You don't have to do anything in terms of liquidating your account. It'll just look at the total net asset value of your account. I'll run a report on Thursday. That will be your final rankings. I had posted to Canvas a week or so ago all of the teams that you're competing against in this section. So what will happen is stock track performance is worth 10 points. 5 of the 10 points is the stock track write-up, right? That's going to be due on Wednesday, May 8th, right? So on Wednesday, May 1st, trading ends. On May 2nd, I'll look at the relative scores of your teams, and then that's worth 5 points. So the worst performing team gets 1 point, the best performing team gets 5, and everybody else somewhere in the middle. The second 5 points for the assignment will come from the stock track write-up. So if you log into your stock track account, on the right-hand side is a link called Transaction History. You need to print that out, right? So what you're going to hand in on Wednesday, May 8th is team name, team members, transaction history, and then a 1 to 2 sentence write-up for each transaction explaining your rationale. So if you bought something, why did you buy it? What was the business rationale? If you sold something, why did you sell it? And it should be a business rationale. It shouldn't be, I bought McDonald's because I thought the fishy commercial for the fishy McBites was really cool. All right, not a business rationale. So again, why did you buy it? Why did you sell it? You don't have to do splits. You don't have to do dividends, but you do have to do each buy and sell. So if you bought it multiple times, every buy has to be written up. If you sold it multiple times, every sell has to be written up. But assuming you turn in the transaction history with your write-up, it's an easy 5 points. So assuming you turn that in on May 8th, the worst your group can do is 6 out of 10 points. And obviously, if you do better, you can do 10 out of 10. Sorry, that was avoiding your question.
Yeah, a couple questions. Wednesday at the close or Wednesday at the open?
It'll be Wednesday close. So basically Thursday morning's report will be the final rankings.
Okay. And I was like, for sometimes in like stock track, when you go to like transaction history, it doesn't say the price you paid, but order history does. Should we just print out the order?
You can print out the order history as well. Yeah, I mean, I guess what I'm more interested in is not necessarily the price you paid. It's just here's the companies I bought and here's why I bought them. But order history works just as well. Either one, I just need a log of what you bought and sold. Right?
You don't really care about the price.
Yeah, I'm less concerned about the price. I just want to know why you made the transactions you made. All right, so that's stock track. Then on May 8th, so Monday we finished the presentations. May 8th is our last day of class. At the beginning of class on May 8th, you have to turn in your written projects for your team, the group projects, and you have to turn in your stock track report write-ups. Right? Then we'll do a review, and I'll hand out, which will be available on Elm's Canvas, your final exam. Your final exam is a take-home final exam. You'll have 1 week or 7 days to complete it. It'll be due at the end of day on May 15th, right? And you'll basically take it all through Canvas. Unlike the midterm, there's not going to be a timer associated with it. So you still have to complete it within 7 days, but you can click on the link and you can come back to the link later. And as long as you submit it by the deadline, that's what's going to be key to the midterm exam. So it's a take-home, it's open book, open notes. It's not a group exam, it's still an individual exam, but nonetheless, you'll have 7 days to take it as a take-home. Yes?
So I'm assuming that it's multiple choice and short answer.
So it'll be similar in format to the midterm. It won't be part A and B. There'll be one exam. But the first half of the exam will be evaluation. So what I'll do is I'll give you a company similar to the midterm company, except I'll give you a forecast. And what you'll have to do is convert the economic statements, including the forecast. Then, given that forecast, you'll have to do an enterprise DCF and an economic profit valuation. And they'll have to match and balance. So you have to tell me, given that forecast, what will the company be worth? And show me that you can get a balancing model. Now, this is exactly similar to the process we use to add to our valuation model that we're using for the group projects. Except, you probably aren't going to be able to use that valuation model to do your final exam. The reason why is our model is built on Bloomberg's financial statement structure. I'm going to give you statements that don't fit into the Bloomberg categories. So trying to put that final exam into the Bloomberg model is not going to work. So what will be easier for you to do is to recreate it from scratch. So think about, basically in the final exam, do the same type of spreadsheet you did for the midterm, just add 2 more tabs to it. Add a DCF tab, add an EP tab. All right? That's half the final exam. The other half of the final exam will be a series of multiple choice and short answer questions, just like the midterm. So another hand, another question?
Sorry, so just to repeat
instead of you creating the forecast, I'll create the forecast for you.
Okay.
And then just given the historical and forecasted statements, what would the company be worth?
Okay, so then we can solve it. So we
Yeah. And you won't have to go to the Bloomberg lab. It'll all be self-contained assumptions within the final exam.
Gotcha.
Okay. All right, final step. So for the group projects, both the stock track and the valuation, there will be a peer review, optional peer review that you will be filling out on Canvas. And I say optional because the way it works is you're going to peer review somebody based on their contribution to one or both group projects. If you feel that everybody on your team adequately contributed and fairly contributed, you don't have to fill out a peer review. We're just going to assume 100% participation. However, if you feel that one or more members of your team did not fairly contribute to either project, you can peer review them and give them a percentage of effort. All right, so let's say 50%. They only put in 50% of what the rest of the team put in over the course of the semester. So if one person gives you a negative peer evaluation, it will not affect your group project grade. If two or more of your team members give you a negative peer evaluation, I will lower your grade. And the way I'll do it is I'll do it based on a weighted average. So let's say if 6 people on your team, taking yourself out, 2 people peer review you for 50%, 3 people don't peer review you at all. So what would happen is I would take 2 times 50%, 3 people at 100%, I would do a weighted average. That percentage weighted average times your group grade equals the score that you will get. So I mention this now because if you are having a problem with your team, peer evaluation is a way to rectify it. But I'm also stating, if you think that your team has any issues with you in the next few days, talk to your team. All right? Generally, if you've had good team communication, this should not be an issue, but that will be a peer review for either project will be an option that you'll have as well. Okay? So that will kind of finish out our semester. So what I'd like to focus on for the rest of our class today is the Walmart homework assignment and talking through that in context of the requirements for the group project. So I had posted to Elms last week all the requirements for the PowerPoint and the paper for each one of the sections. And so I want to talk about those sections in context of Walmart. So one of the sections, first section is EIC. So for EIC, you'll need to go to the conference-board.org website. And then you'll need to, on the right, click on U.S. Indicators, and then click on LEI, Leading Economic Index. There's a press release with the graph and summary. If you click on the latest press release and scroll down, here's the latest LEI-CEI combo chart. So this is the graph from April with March data. And you can see that during that month, in March, the CEI went down a little bit, as did the LEI. So now what you have to do is you have to kind of read some tea leaves. And you have to say, given particularly the drop in LEI, what does that mean for the U.S. economy? Is this just, in your opinion, just a trend down on the way that it continues to trend up? So this is just a slight dip, and it's going to keep improving, and the economy goes well. Matter of fact, last week GDP came out, was it 2.5%, 2.3%, something like that? So again, the question is, what's going to happen to GDP in the rest of the year? Is it going to start slowing down, or is it going to stay strong? That's what you need to tell. So there's some data to give you some trends on the economy. What matters more is the last couple of periods. In addition, you have to go to Bloomberg. And again, I'll look up Walmart. And you'll have to show me their 5-year equity beta. So again, go to beta. Make sure you do 5 years, 2008. And you can see that Walmart has a 5-year beta. So you have to have this screenshot in your PowerPoint, 0.447. That's their raw beta. Their adjusted beta, 0.631. So remember, Bloomberg for the adjusted beta just takes 2/3 of the raw and 1/3 of 1 and multiplies it as a weighted average. So they just smooth out the betas because they put in a regression coefficient, right? Now, I'm not going to argue whether or not that's a good way to do it. There's a lot of statisticians that do this for regression to mean purposes. But the point is, for our class, we're going to use the raw beta for the EIC. which is the actual slope of this trend line. So for Walmart, 0.447. So the question, somebody had a hand? Yes?
I think it's going back to the LEI and CEM. So what are we supposed to base it off of? Like you said, there's a little dip. How are we supposed to decide whether we think it's going to go up or go down?
You have to give me your opinion. So you have to basically say, given the slight dip, does this mean that the economy is going to start slowing, or is this just sort of a technical dip and the rest of the year still looks strong?
We have to give you a reason why it's just a technical dip.
Just your opinion more than anything else. But that's what I said. We saw a little bit of a trend down in the LEI, and right now there's a concern about global growth, and so the question is that going to spill out to U.S. growth as well? That it's just your opinion more than anything else. But that's the point. What's our opinion of the economy, and then beta, what's going to impact our company, right? So what will we say about Walmart's impact? They have an equity beta of 0.447 over the last 5 years. So what can we say about Walmart?
Less volatile.
Yeah, much less volatile than the market. So to some degree, for Walmart, it's not going to matter nearly as much whether we think the economy is growing that much, because they're not going to be too dependent on changes in the economy, right? Matter of fact, Walmart did pretty well in the last few years because as people had tougher economic times, I think they traded down to Walmart, and they actually did pretty well in the tough economic times. And that's actually one of the challenges I think Walmart is facing today, is as the economy is getting better and people feel better about themselves, they're trading up from Walmart, and Walmart's having some trouble with growth. But that's the point. They're a fairly steady company regardless of economic conditions. So that's really what we need to say in the E section of our EIC. Right? Next, we're going to do the I section, which is the 5 forces analysis and the overall position of the industry. Right? One thing, if you haven't done it, that will help you with the industry analysis is the Ibis Reports off the portal. Okay? So on the portal, Ibis World. And in Ibis World, let's go back to the main page here. When you log in to the portal's main page, you can do a search for a company or an industry. In this case, I type in Walmart, and it'll tell me which industry reports they're part of. Now, in this case, for Walmart, I'm going to go to More Results, and the industry I'm really caring about is warehouse clubs and supercenters. So I open up that report. And a useful section is Industry Outlook, because in the Industry Outlook, they're doing a 5 forces analysis. They're talking about impacts of the economy on the companies. So again, because we're doing real-world companies, it's perfectly acceptable to use these real-world data sources to help you answer these questions. Don't plagiarize. So set up a bibliography if you use external sources. If you quote, put in a footnote. But otherwise, attribute, but feel free to use these other data sources to help you answer these questions. The other thing that's very helpful about the Ibis report is they give a long-term revenue growth rate for the industry. Right? So this will help me understand what the growth rate is, and this will start to help me when I do the valuation to put together a forecast that's more realistic for sales growth. So for example, one of the things that colored my as-is valuation of Walmart was the fact that by 2019, this industry is expected to grow about 1% a year. So from about 4% today. So basically what that means is that Walmart is probably going to be growth challenged. So that when we did our valuation, we did both the baseline and the as-is and the final. In the baseline, if we just put in all the data for the company, we should have ended up with a stock price around $189 a share. Right? Now somebody said in the lab, they asked me the question, they said, well, Costco was only about $10 more than the current share price when we did the baseline. Why is Walmart so much more? And the answer really has to do more with the fact that what this setting up the valuation is sensitive to is the next 2 years. And Walmart has a pretty good next 2 years. And so if we just extrapolate that out forward, Walmart's going to be worth a lot. Right? But obviously the market, given that they had a $78 share price, doesn't think that the next 2 years are indicative of Walmart's future. Right? And that's where the growth analysis starts to help me, because I'm seeing that Walmart is in an industry that's expected to grow about 1% long term. Well, obviously, right now, growing at 4 or 5%, seeing that growth rate's low is going to start eating into that share price. So that starts to help me as I start thinking about my as-is valuation. Right. The other thing I'm going to have to do in the I section is I'm going to have to go to Bloomberg. I'm going to have to go to the RV screen. I'm going to have to look at my industry peers. So in this case, I'll look at my Bloomberg comps. And then we had set up a template earlier this semester, which we called spread. ROIC of all the companies, WACC of all the companies. Select stats, market cap weighted average. So I now have an industry average ROIC, an industry average WACC. Right? So part of what I'm trying to do at the industry level is answer the question, is this an attractive industry? Is Walmart's industry currently an attractive industry? Yeah, it's very attractive. So in my 5 forces, I'm going to have a 5 forces table. And I need to score the overall industry given that ROIC against the WACC. I'm going to call that a 4.5. I'm going to say Walmart is in a very attractive industry. And then I have to use the 5 forces and create the table just like we did in the homework. Why is Walmart in an attractive industry? So which of those forces is really helping Walmart's industry make a lot of money? The supercenter industry, the discount industry. Yeah.
Supplier power.
All right, so the suppliers don't have a lot of power, so give me a number for my index.
I would say probably 5.
All right, so if we scored a 5, what we're saying is not that the suppliers have power, we're saying they don't have power, which means it makes it easier for the industry to make money, which explains the high industry ROIC. And again, it's not just Walmart, but think about the size of Walmart. They're like $460 billion in revenue. You got Costco, which is going to be like a $70 billion company. You got Target, which is a $70 billion company. So you got these very large companies, and they are exercising a lot of buying power over their suppliers. I remember reading a couple years ago that 20% of Procter & Gamble's sales are Walmart. Right? So think about who has the power in that relationship. And I think they're exploiting it, and that's why it helps them make more money. Right? So when you talk about the forces, you got to talk about your rationale for the scores for the forces in your PowerPoints and in your papers. Right? What else is helping this industry? Yep.
The entry and exit,
What would you score that?
a 5.
Really hard to build a national retail chain. All right, so a brick and mortar national retail chain to compete with the supercenters of Walmart and Target, it's going to be hard to build those. So I think that gives them natural barriers to entry in this business, which again helps their profitability because you're probably not going to see a new competitor jump in this industry anytime soon. What else? Is there a lot of rivalry in this industry? Part of it goes back to look at how many peers there are. There's really not that many big competitors of Walmart. I mean, besides like Target, a Costco, maybe a BJ's, there's really not that many choices that we increasingly have today for those types of supercenters. And so therefore, I think there's competition, but I think it's more Coke-Pepsi competition. It's more sort of cooperative competition than intense cutthroat competition. And so I think that probably supports them getting a little bit better margin and explains why the industry is doing pretty well right now. Right? So yeah, maybe call that a 4. But I also think that means that I think as buyers we have choices, but to some degree I don't think our buyer power is that strong because of that rivalry, because there isn't that much choice. So even though we have choices, like the prices aren't that dissimilar anymore amongst all these stores. So where am I really going to go to play one off of another, right? Now, the other thing I'll define, substitutes in my opinion, is online. And right now, I don't think online is dramatically hurting the profitability of the industry. So Amazon, yeah.
When you say buyers, are you talking about the end customer
The customers,
Are you talking about?
you and me, walking into Walmart, buying whatever we buy.
That was the buyers like within Walmart buying actual product.
No, it's the customers of the company. So it's my customers. Right. So back to entry and exit and subs. I don't think that the substitutes are that strong today. I think that there are strong substitutes. I think Amazon online is a big threat to this industry, but I don't think it's really impacted it yet. Right. But that's the point. Now I'm thinking 5 years from now. I think in 5 years, the biggest change is going to be the substitutes. I think that Amazon and the online companies are going to be a big threat to Walmart. Matter of fact, I also think it's going to lower entry and exit barriers. Think about a company like Zappos, which is now a national brand, and the fact that they don't really have brick and mortar stores, that they're creating this brand almost completely online. And I think that that allows more competition in this industry than what we've seen, is that you can have essentially virtual retailers. And at the same time, look at myself. As an Amazon Prime member, I've probably made 38 purchases year to date because I pay one price and I get unlimited free shipping for 2 days. So it's easy to buy toothpaste. It's easy to buy razors. It's easy to buy mouthwash. Just click and it just shows up in 2 days. Like, why bother to even go to the store sometimes when I can just have it delivered to my home, and even without sales tax right now, which is about to change. But that's the point, is that even when you throw in sales tax, there's still compelling online competition, which I think is going to be tougher on this industry going forward. I also think that's going to put a little bit more power in the hands of the buyers, and I think it's going to increase the rivalry slightly in the industry. But I still think the suppliers are not going to have a lot of power. But what I do think is that the overall ROIC in this industry is going to be a little bit lower 5 years from now than it is today. I still think that there'll be a positive spread. I just don't think it'll be the spread that it is today. Right? So notice when I was going through this example that I was giving rationale for each of the forces. That's what you have to do. So you have to show me your table. You have to show me your RV screen of how you actually got the data to start with, and then give me your rationale for the forces today, why you think they're going to change, and what it means for the industry ROIC in 5 years. Right? That's basically what the I section of the EIC is. And again, this is going to help you with your valuation, because I've already started establishing a couple parameters. 1, lower sales growth. 2, lower ROIC at the industry level. So I would expect that Walmart's ROIC in the future is going to be under pressure when I start forecasting it, because the industry's ROIC is going to be heading south. Right? Now, the final part is C, competitive advantage. I need to go back to the RV screen. Does Walmart, given this data, have competitive advantage? Yes or no?
Yeah, I mean, just based on what their market cap is compared to the other countries.
We're not looking at market cap for competitive advantage.
Barely.
Isn't their size a competitive advantage then?
And the reason why is we're defining competitive advantage in this class as ROICs higher than industry average. If the size really gave them a competitive advantage, they would be out earning their peers. And right now they're not. So therefore, they're not exhibiting real financial competitive advantage the way we're defining it. So I would actually say Walmart lacks competitive advantage. They're just earning the industry average. Now, if you did it based on spread, ROIC minus WACC, you could say Walmart is outperforming the average a little bit. But I tend to base it more on ROIC with the assumption that the real risks of these competitors on the asset beta side is probably not that much different. That the real differentiator in cost of capital is probably on the capital structure side, right? That the risk of a Walmart versus a Target, I mean, the risks are the risks, or a Costco, they shouldn't be that different. So to me, the more important differentiator is what ROIC are you earning? Now, if we're talking about a startup with a lot more risk, different story. But amongst the established players, I don't really see Walmart out earning its peers. So again, ROIC for the company against the average. So it lacks competitive advantage. Question then becomes, in 5 years, will this situation change? My belief on Walmart is no, it won't. But I think that Costco and Target, as very large firms, can leverage their supply chains. Everyone's doing the global supply chain these days, right? So when I think about Walmart, I don't think they're going to be doing much better than the industry in 5 years. I think the industry is going to get a little tougher, and that's going to color what I think about my valuation. So I keep referring to this because When you're doing your projects, your team needs to talk to each other. I'm sure there's been a division of labor on your teams. And I'm sure there's a part of your group that's doing the valuation. But they should be looking at the EIC analysis because the EIC helps you do the evaluation. The worst thing you can do on Wednesday is contradict yourself because you don't want the EIC to be saying, oh, everything looks great, and then the valuation, we're going to hell in a handbasket, right? There needs to be a consistency amongst the data between your sections, right? So that's the EIC section using Walmart as an example. Next, we'll talk about the 5-year historical analysis. 2 parts to that. First, it's going to be the ROIC drivers tab. The ROIC drivers represents the 5-year historical ROIC tree. The nice thing about the model we're using is as soon as you import the data, the ROIC tree will be updated, right? So you don't have to do the valuation to do the ROIC tree. Once the historical data is in there, the ROIC tree is calculated. So what we have to do is we have to go through and explain the 5-year ROIC. Again, I keep repeating this. Because this is a finance class, you have to refer to specific numbers, right? You can't just refer to general trends. So, example, Walmart's ROIC end of year went from 13.3 to 13.7%, improved over the last 5 years. However, that improvement was actually due to a slightly lower tax rate. Their tax rate went from 34.2 to 31%. That's why their end of year ROIC improved. If you take out the tax benefit, Walmart's pre-tax ROIC fell from 20% to 19.9%. So the slight decrease in pre-tax ROIC. Right? Now, why did it slightly decrease? Operating margin actually went up from 5.6 to 5.9, which would have helped the pre-tax ROIC. So the primary reason that their pre-tax ROIC went down was the invested capital over sales, or what we're calling productivity. That Walmart's a little less efficient today than what they were 5 years ago. Right? Where 5 years ago, they were at 27.9 cents of invested capital per dollar of revenue. Now they're at 29.8. So they're tying up more capital to sell the same merchandise. Right? Now, digging deeper, why did the margin go up slightly? Well, the gross margin went from 26.5 to 26.7, so a slight improvement in gross margin. At the same time, SG&A went from 19.2 to 18.9, a slight decrease in the cost of running the business, the operating expenses. Those two combined explain the increase in the operating margin. In terms of the productivity, operating working capital stayed the same, about 0.5 cent. The difference was PP&E to sales went from 23.7 to 24.9, spending a lot more on property, plant, equipment, the stores, relative to their revenue. And intangibles, which are the acquisitions, premiums, 3.8 to 4.4. Right? That also was a little bit hurting of the productivity. But the primary reason was PP&E to sales. So it's store productivity is the issue for Walmart with the slight decrease in productivity. If you notice what Walmart is now doing as a corporate strategy, they've announced that they're now starting to create stores that are the size of a Walgreens or a CVS. So they're saying rather than having the big supercenter, they're going to have Walmart neighborhood markets where they take the fast-selling merchandise, put it in a smaller store, but that addresses the productivity of the stores because they have these giant supercenters and they're not getting the leverage out of them, particularly as they go into smaller towns or into urban environments. They're looking at smaller stores as a way to drive sales growth without over-investing. And I think that's a direct result of this decline in productivity, the way they're trying to address that. Right?
Question.
Yes?
Say your company operated at a loss for like one of those years.
Yep.
In 2009, but you just ignore that year and then go on from 2010 to 2011.
Well, I mean, I would still state they lost money,
So they didn't really pay.
and therefore they either didn't pay taxes at a very low tax rate. And then actually in the years they're making money, they might have an artificially high tax rate, or they could have the opposite. They could also have a lower tax rate in a future year because they're getting a tax loss benefit, which is reducing their earnings. So sometimes you'll have some jumps around. Just kind of explain the jumps, and you have to use a different year for normalization. That's fine as well.
Okay.
Right? So once you got to have the ROIC tree in your PowerPoint, in your paper. Once you finish that, you got to do CFI. So you need a 5-year historical CFI. Again, easiest way to do this, hide, don't delete, the forecasted columns. The totals are already there, right? Again, you're going to focus on the 4 major areas of CFI. So, first one, gross cash flow was about $123.8 billion. That Walmart's gross cash flow went from about 21.7, consistently increasing their gross cash flow to 27.6 billion over 2013 over the 5 years. They reinvested in capex and working capital, 57.5 billion, generating free cash flow before acquisitions of 66.3 billion. Spent another 4.6 billion on goodwill and intangibles, giving them free cash flow after all investment of 61.6 billion, or a 50% reinvestment rate. So Walmart has about a 50% reinvestment rate of its cash and approximately a 50% payout rate of its cash, right? That's the 61.6 billion. From there, Walmart increased its non-operating cash flows by a little over $1 billion to get CFI of 62.7 billion. And a lot of that came from an extraordinary gain of $1.034 billion, which mostly occurred in the year 2011. Right? So they probably disposed of something which they sold at a profit, and that represented the vast majority of the gain in the CFI from non-operating items. Right? They also did get a little bit of gain from selling something else non-operating, or non-operating gains, about $600 million, offsetting the increase in non-operating assets and the increase in excess cash. Right? But again, about 62.7 of CFI to pay out. And then the question becomes, where did that cash go? Right? Generally, it's going to be debt or equity. So for the debt, $7.4 billion worth of interest. And what's interesting is Walmart issued $9.5 billion worth of new debt. Clearly, they didn't need to do that. They had plenty of CFI, plenty of free cash flow. So here's a company that strategically issued the debt to most likely, and you'll see this, $22.8 billion worth of dividends, $39 billion worth of share buyback. It clearly looks like Walmart was issuing the debt to fund share buyback. If we go back to Bloomberg, there's a screen called Credit Profile, CRPR. This is a company's credit rating. And for the 4 major credit rating agencies, Walmart is rated AA. AA, AA, and Moody's has this weird A, which is another way of saying AA. Right? So basically they're rated AA. Right? Very good credit rating. So I think what they were doing is taking advantage of their credit rating and low interest rates to issue debt to buy back stock. Because if you think about it, Walmart put about $63 billion over the last 5 years in the hands of shareholders through stock buybacks and dividends. That's pretty much their CFI. So really, the debt paid the interest and the payments to the minority shareholders. Right? So essentially, they used it to leverage up their firm a little bit. So that's what we needed to say about CFI. That's section 2. Section 3, the multiples. So in Bloomberg, again in the RV section, you need to narrow down your competitors, your comps, to 6 total peers. Yours plus 5 others. Right? So it must be 6. Then we had created a template earlier this semester for the multiples. So here's all the multiples for those peers. Right? And then we need to do a select stats at a market cap weighted average. And then we need to do our multiple analysis. So what I really want to start out with is Walmart against the industry average. Now I have their long-term growth rate on the screen. Now the long-term growth rate that's in Bloomberg is the long-term growth rate in earnings per share. It's the 5-year earnings per share growth rate. In our model, we're actually looking at G, which is the sustainable growth rate in the perpetuity of cash flow. Now, obviously, the growth in earnings and the growth in cash flow are not the same. So the assumption we're making is that they're correlated. So a company that has a higher long-term growth rate will have a higher G, right? Not the same magnitude, but directionality. And if it's growing its earnings faster, we're going to assume it's growing its cash flow faster than its peers. Right? So what do we see about Walmart? Well, Walmart has a little bit lower growth rate than the industry. Price to book a little bit lower than the industry, but close to the average. PEG a little bit higher than the industry average. But notice PEs that are lower than the average. EV to EBITDA that are lower than the average. EV to EBIT and EBITDA are lower than the average. EV to sales lower than the average. So, what this suggests with similar PEGs and price to book is that I infer that Walmart probably has a similar ROIC to the rest of the industry, but the reason that they're trading at a discount or have lower multiples than their peers is because of the lower growth rate. So I think that Walmart has a similar ROIC going forward to the average, just slightly lower growth, and that's why they're trading at lower multiples. Right? Now, I then want to talk about some other peers. So if I look at Target compared to the average. So Target has a higher growth rate than the average and Walmart. Target has a lower PEG and a lower price to book. Target has a lower PE than the average. Target has about the same EV to EBIT as the average, slightly higher and then same. They have slightly lower EV to EBITDA and slightly higher EV to sales. So here's what I'm going to say about Target. I think Target has a lower expected ROIC, but a faster growth rate that's giving them slightly better multiples at the EV to EBIT and range. And to some degree, this PE being as high as it is. So the point is, I think Target has a positive spread, so the growth rate is valuable. But that's the point. They don't generate as much ROIC, but they're getting more cash from that ROIC by growing it faster, giving them similar multiples. Right? Where Walmart, with slower growth, probably has a little bit better ROIC than Target. At the other end of the scale, the industry, Dollar Tree, Dollar General. They have some of the fastest growth rates in the industry, but if you look at their multiples, particularly at Dollar General, very high growth rate, but their PE is at or below the industry average. Their EV to EBIT is, again, below industry average. The EV to EBITDA is about the industry average, so slightly higher. A little bit better EV to sales, but that's the point. I think that slightly lower, though still positive spread ROIC, and fast growth gets them those multiples. But that's the point. It's pretty clear that Dollar Tree and Dollar General probably have the lowest ROICs in the industry. So what you're really trying to do in this analysis is come up with a relative ranking of the peers. Right? Notice I did 4 of the 6 peers, and that's sufficient. You have to do all 6. But you can't just do your company in the industry average. You got to talk through more and give a general relative ranking of the industry and what the multiples infer about the relative ranking of expected ROIC, because we kind of already have an expected growth rate. All right, so that's what we need to cover for the multiple section. Questions about that? All right, finally, your valuation. But again, just to reinforce, part of the reason why we did these other 3 sections is they now give us a lot more insight when we go back to that valuation. All right? So I posted to Elm's Canvas my as-is and my baseline. So again, in the baseline, when you put in all the raw data from Walmart, came in with a share price of about $189. And Walmart was, again, targeted for share price within $1 of their current share price, somewhere around 77, 78. So I need to cut the share price. Well, that's where, again, I go back to that EIC. So what I did in my as-is is I took the revenue growth rate, and I eventually took it down from about 5% in the next 2 years down to about 1% long-term. Again, kind of following the industry trends. On the assumption, so again, I'm explaining the rationale for my assumptions and my point of view, that Walmart, which doesn't seem to have tremendous competitive advantage over its peers, is probably going to end up with similar growth rates to the rest of the industry. Right? And again, that was expected to be about 1% long-term. It also meant that I need to adjust my continuing value G. So again, this is the long-term growth rate in cash flow for 10, 20, 30 years into the future, right? So in the long run, that number is probably going to be 0 to 6% for most companies, right? The general assumption is that you should grow long-term at about the rate of the economy, somewhere around 3%. That was our default assumption. But what we see for Walmart is discount stores are expected over the next decade to grow slower than the economy, and particularly in the out years at 1%. So therefore, I'm saying that Walmart, in its long-term continuing value period, is also going to grow around 1%. Right? So by doing that, that got my share price down to around 90. So the final thing I did is I said, you know what? I think there's going to be increasing competition. Talked about it in the I section of the EIC. And that increasing competition is going to put pressure on margins. So basically what I did is I knocked out about a point of margin, down to about a little under 5% operating margin by increasing my cost of sales about 1% over time. So that's how I got to about a $78 share price. Right? So again, my point of view that I'm giving for the as-is share price is I think the market is expecting a long-term growth rate slower in the U.S. economy, about 1%. And I think that Walmart's going to get slightly compressed margins due to increased competition, and that explains the current share price today. Right? So that's what I need to say for my as-is valuation. What are my assumptions? Highlight the assumptions. Highlight your rationale for the assumptions. Right? They could be different, but again, you're giving your point of view. So it's not saying there's one right answer, and when I grade you, that's the point. I'm not going to be saying whether I agree with you. It's a question of, are you sort of making common sense? Are you coming up with reasonable assumptions that are somewhat fact-based based on what you now know about these companies? Right. So I then have to go to my final valuation. Do I think it's a buy, sell, or hold? Do I think I want to change the assumptions to make it worth more or less? So let me just ask you, did anybody here come up with a sell for Walmart? You came up with a sell? What was your rationale?
I thought they weren't going to be growing much, and I read something about how they were cutting back they cut back on the number of employees, and it was just leading to like long lines, so they were going to have to increase the number of employees.
Which will hurt their margins.
Yeah.
So you think that their margins will actually get a little bit worse?
Yeah.
Is that what you probably put in? And therefore create the sell rating. All right. Does anybody have a buy in Walmart?
Yeah.
What was the rationale for the buy?
I have similar growth for
Yep.
the as is, but then kind of doing more research, I realized that I don't think they're going to trend completely to the industry because they are stronger than most of their competitors, and I think that with the e-commerce and like emerging markets, they can offset any lack of growth in that.
All right. So here's the point. One person came up looking at this data with a buy. The other person came up with a sell. Those could both be the right answer. And that happens in the real world all the time because, again, we're predicting the future and we have to come up with a reasonable point of view. So given what you both said, you could both get credit for this so long as you kind of gave a case for why you're coming up with the buys or the sells. Matter of fact, you could also give a hold on Walmart. Matter of fact, that would probably be my ultimate recommendation on Walmart, is I personally think that Walmart is fairly priced. And I do think that Walmart is going to be challenged with growth, and I think they are going to be a little bit more challenged with margins. And I think that the scenario that plays out for the as-is is probably pretty close to their long-term scenario of what I think will actually happen to Walmart. So for me, it's not that they're a bad company. I just think they're fairly priced, given that the assumptions they're probably going to reasonably earn over time. So I don't see a lot of upside in buying Walmart. Yeah.
So we looked at like Walmart's like spread, and
Yep.
from that we saw that they don't necessarily have a competitive advantage.
Well, if we looked at the Bloomberg spreads,
right, just
it appears that their performance is in a good industry, not that they're really outperforming their peers.
right. So
Yeah.
my only question is that like, I mean, from what I know about Walmart, they definitely have a competitive advantage with regard to suppliers and the cost that they're getting.
But they're not translating it into better
Well,
returns.
My only question is whether they actually are, because I mean, if you look at the ratios tab,
Yep.
I felt like that. Like for my as is, I just made like I slightly upped their cost of goods sold just a little bit so that it would go up over the next 10 years, and that basically completely reduced the price down to like the current.
Yeah, when you're a low margin company, slight changes in margins can have very big impacts on the share price.
Right.
And that's what you can quickly see. So in Walmart, they are going to be very sensitive to those margins. And if they can get more leverage out of their supply chain, then that could be a very good case for a buy that Walmart's undervalued. Because right now the trend is the other way. But I don't think the market's probably not worried as much about the cost. I think Walmart is more causing investors to worry about the prices. Because increasingly the prices across stores are becoming more commoditized. I mean, if you want to buy a new PlayStation and you go to Walmart or you go to Target or you go to Costco, price is the price. You're not going to really save that much money at any of those stores. And so I think that's the worry, is that particularly with online driving prices lower in many cases, then is Walmart going to have to match those online prices of people without the infrastructure? So even though they don't have the supply chain advantage, they don't have the actual supply part of the chain. And so therefore, that could mean lower prices, and that's where I think people worry about the margins. But again, there's some debate in that. And so it just depends on your point of view, but that's the point. For your point of view, is Walmart's an interesting company because depending on how this plays out, now could be a really good time to buy Walmart. Now could be really a time to avoid Walmart. And it really just depends on what they do with that revenue and margin. Yes?
Just out of curiosity, can you check their previous post before 5 years ago, their cost of goods sold, what it was? Is it from 5 years ago? It's decreasing down to what it is now.
Yeah, I mean, just you can add more columns in the model if you wanted to look. And to be honest with you, I don't really know because I didn't go back and look. But I mean, you could do a longer term analysis. I just think that the last 5 years are probably more important than say 10 years ago because the industry's evolved. But what really matters is not the last 5 years; it's what you think about the next 5 years. Right. So, for example, one of the groups in the previous class is doing Apple. And one of the challenges that Apple has when they just announced their earnings last week is if you look at the RV screen for Apple, and if we look at their peers, use this peer group. One of their problems is that their margins, particularly gross margins, have fallen. That used to be about 47% and now it's 43%, which means their EBIT and EBITDA, which is still far higher than the rest of the industry. As a matter of fact, their EBIT and EBITDA margins are approaching 38% and 35% in an industry that's making less. But that's the problem. Due to the competition, particularly from Samsung, Apple has introduced an iPad mini. The iPad mini is a lower margin product than the iPad. There's fear that Apple's going to introduce, by the analysts, a low-priced iPhone. And to some degree that hurt Apple last year because people are still buying the iPhone 4S rather than the iPhone 5 as a cheap alternative. They make less money on the lower price older iPhones. And so that was the point. Apple had a blowout year in sales, but the margins started to drop. And that's what the analysts were keying on. Now, over time, I would expect that Apple's margins eventually approach the industry average. And that's really the challenge with Apple today. Is people are fearing that that's actually what's starting to happen. That yes, they're getting reasonable growth, but it's growth at a much lower margin, and that's the pressure on the valuation. Now, you have some people that think their margins are going to completely collapse. I'm not one of them, but I do think the margins are starting to erode, and they're not going to have that level of premium brand. But we know that about competition over time. You generally don't outperform your peers for too long before you start to regress to the mean. And I think that's what's happening to Apple, a little regression to the mean. All right, so you did your as is. You gave your assumptions for your final. You talked through the final share price. And then the last thing you have to do is you got to put up the ROIC chart. Everybody should have this in their PowerPoint. Everybody should have this in their paper. And then this is the last thing. You've done your buy, sell, hold, and then you have to defend it. This is your defensible, independent check. So here's why I believe I have a reasonable hold on Walmart, which is I said that in the EIC, the industry was going to get slightly worse, and so therefore, with no change in competitive advantage, 14 to around 11 is the worst. This is the poor industry, the lower growth, slightly lower margin EIC. So this makes sense in context of what I said in the EIC section, right? And that's really the point. Why is Walmart at $80 a share? Because their ROIC is going to trend down towards 11%. Are they still earning a premium over their cost of capital? Yes, they're still creating value. They're just not getting the returns on investment that they're currently getting. That's the rationale for the hold. Now, if I did a buy, and there's some people that have turned in papers where they said $90 a share price, the difference is this chart is going to probably look like a trend line that goes up to here. Basically about flat ROIC. So it's not saying that's not impossible. What you're just doing is you're giving different dynamics. So if I believe the industry is worsening and Walmart maintains a 14% ROIC, then it goes back to your point about competitive advantage. Then Walmart is really leveraging their competitive advantage to maintain their ROIC in a tougher industry. So I could have 2 points of view, depending on what I think happens to them, that could easily be explained given two ROIC charts. What I probably don't want to see is an ROIC chart that's constantly trending up from 14 to 16 to 18 to 20. That would be very hard to explain over the long run. So that's the point. This is your sanity check. This is the last thing that you have to turn in as part of your valuation.
So whether it goes up or down, as long as it just regresses towards the mean.
Well, as I said, we just believe that there's a natural tendency to regress to the mean over a long period of time as the company becomes more mature. So that should be our bias. It doesn't mean that's the only answer. Right? There could be exceptions to the rule, but that's the point. You'd have to explain, why is my company an exception to the rule? What are they doing that's allowing them to out-earn in the future what they're doing today? And particularly in the long-term future when we're more mature, I'm not saying it's impossible, it's just harder to do. So that's going back to, hey, if it's not a great industry, then it's got to be real competitive advantage that's really allowing them to outpace the firm. So as they're getting bigger, they're getting more competitive advantage. Then I have to buy into that and believe that that's the case. But my bias is that's not the case over the long run. My bias is you tend to regress to the mean. That's what the data suggests historically. So again, it's not saying you can't have an upwardly sloping chart. It's just you got to have a reason for that, a compelling reason to say, why is this trout swimming upstream when all the other trout are swimming downstream? That's the group project, 2 group projects. That's Walmart as our case study. Again, I uploaded all of these files to the files section of Canvas, so they are there to view. One last thing is if you're not using it, did we talk about the analyst reports earlier? And using the analyst reports on a Thompson 1? All right, so here's the last thing I'll mention. If you haven't done this already, and I know it's late in the game, on the Smith portal, smithapps.rhsmith.umd.edu, if you log in, one of the links is to a data service under the Finance tab called Thompson 1. Thompson 1 is a competitor to Bloomberg Professional. Right? I tend to think that Bloomberg is a better data service, which is why we're using it in this class, but you can get a lot of similar data out of Thompson 1, which is Thomson Reuters product. Right? So, for example, they have historical financial data, they have estimates, they have a lot of the same data. But here's the one thing the Thompson 1 product has on the portal, which is if I go to Walmart, WMT, and then I go to research, under company research, these are analyst reports that are available to us under our subscription. So what I'd recommend is look at the banks that are writing the research reports and go with a couple of recent research reports from banks that you've heard of, right? So Deutsche Bank, probably heard of them, probably a reasonable research report. Value Engine, not so much. So as I look through the list, Cowen and Company, JP Morgan, Jefferies, Deutsche Bank, Susquehanna, Wells Fargo. Matter of fact, you'll notice that the Wells Fargo analyst is scored very high, 4 stars, What that means is they're pretty good at guessing earnings estimates versus actual earnings. So the Wells Fargo analyst has a pretty good track record of scoring Walmart. So obviously, I'm going to give a little bit more weight to this analyst's opinion. But in these reports, the analysts are talking about key trends for the company, and they're making financial projections. Some of them actually include valuations. So again, and they write their buy, sell, hold opinions. So you're welcome to, again, use this data to influence your thinking of the company that you're doing. So I just want to make sure you knew that that was available to you as well. All right? So, other than that, on Wednesday, there was no attendance today, so it's an attendance-free day. Right? So on Wednesday, you need to come in ready to be presenting, turn in your PowerPoint at the beginning of class, and then we'll have 3 teams start on Wednesday. So to the degree that you can get here even a couple minutes early so we can start the presentations on time, we have to complete 3 of them on Wednesday, and then whoever doesn't present on Wednesday will present on Monday. So other than that, I will see everybody on Wednesday. Have a good day.